Welcome to this episode of Navigating the Markets, coming to you live Wednesday, February 5th, 2025, with me, Markets and Mayhem. A little bit about me. I've been doing this for 20 years now. I know that dates me a bit, but it also means I have a well of experience to draw from when I'm sharing my insights and helping you navigate these markets. Speaking of the markets, let's get into an overview. Today, we saw some selling really led by Google, Tesla, Amazon. AMD saw some selling, as did Uber. But overall, this was a well-bid market. And this was a market that had a lot of reasons to come into today being a little more skittish, but pulled through and really showed some resilience that we'll talk about in some of the later technical analysis charts that has me quite encouraged here. Zooming out a week, this is a week heat map. The last was 1 day. We can see that broadening out effect. We can also see some of the rotation out of tech and out of some of the more defensive areas of the market into a broader rally. So this 1 week heat map tells you that bit of that picture. Now let's zoom out to a month. You can see it even more. That broadening out and a bit of a rotation out of some of the crowded tech trades like Nvidia, Tesla, Apple, Microsoft. This is healthy. This is what you want to see. This is constructive for the broader market because what it tells you is there's this broadening out of participation as well. So let's get to the technicals. S&P 500 looks really strong here overall. 3 days in a row of making gains. And remember, Monday's open was quite violent. We had this tariff tension from Friday afternoon into the weekend. And then we saw a little bit of compromise being struck with Mexico and Canada. That helped to salve the nerves of the market this week. So we came in from the weekend with a lot of tension. And really from there, that tension began to melt away. As we saw, there is at least initially an intent to try to bridge some of these gaps and avoid some of the worst consequences of a trade war. So 3 days in a row, S&P reversing off of its lows, making these gains and showing us strength now above the 21-day EMA and 50-day SMA, both of which are important momentum indicators that I watch very carefully. We also see the MACD histogram just starting to inch a little bit more into positivity. So overall, at the top level in the market cap weighted index of the S&P 500, momentum is improving. We see that in the NASDAQ as well. Very similar look, 3 days in a row with this reversal look from Monday on, moving back up above the 50-day SMA and 21-day EMA, and the MACD starting to inch back into constructive momentum territory. This all tells me that the two most important indices for this market are giving us buy signals. Then we have the Dow Jones, which really corrected earlier, right? It corrected, like we had this blast off from the results of the election initially, then a consolidation, another big move. Then we made this new low and a lot of concern on this new low. We also saw a 21 under 50 death cross. That is one variety of death crosses that can happen. And the Dow really languished for a bit, ultimately making a new lower low before reversing and getting back into positive momentum. Now, I think this chart is sort of foretelling where we're likely to see the S&P and NASDAQ go, in the sense that we're just starting to see this positive momentum come back. I think there's some more to come. I think we'll see some continuation. Now, the Russell argues the other side of the story here. It has been very weak off of its highs. You had that post-election surge, a drop like the Dow. We made a weak new high on this wick, and then we just rolled over, consolidated, rolled over again, and now we're finally making a push above the 50-day, and we finally have some constructive action on the MACD histogram. So I would say the Russell's looking better, but of all the indices, it's the worst looking of them. And it's really struggled for a long time. 40% of its components don't make money. So that also becomes more of a concern during earnings season when we get these results and investors scratch their head and wonder, how many of these companies are going to dilute me? How, should I be getting out of the way of that and just rotating into better quality mid caps and some of the blue chip large caps as well? So again, Russell 2000, of all of them, I'm the least optimistic about. I really like the way the NASDAQ and the S&P are looking here, but there's two opportunities I have that I'll share later in this presentation as to specifically where I want to try to capture some of that momentum. Speaking of momentum, New York Stock Exchange highs versus lows looking really good here today. We have this 121 excess of new highs versus new lows into the close. That's that broadening out. That's that turnabout that we've been seeing really happening over the last several weeks, obviously interrupted a bit on Monday. But underneath the surface, this is a market where a lot of the internals are actually improving. Here's another way of looking at that. This is the New York Stock Exchange percentage of stocks above their 20-day simple moving average. Right now, it's 66.11. That's below my overbought reading, which would be 70 and above that. And we could see the last time we hit that, we rolled over and so did the market. So right now we're seeing strong breadth, right? Really, I'd say anything over 60 is that strong breadth, and typically you see a continuation higher. When you're seeing that breadth improving, it typically gets a little bit exhaustive to the upside. So we're not overbought yet. I suspect we'll get overbought before this particular move is over. Let's also look at this through the lens of the options market. We know that S&P 500 index options trade about 1 trillion of notional every day, with about half of that zero DTE or expiring within about 6.5 hours or less, and with about 75% of the total expiring within about 5 trading days or less. So this is a very short-dated market in terms of the interest of duration in options, and that's one of the reasons we really watch the entire chain, because most of it is short dated, but there's still plenty to be aware of, even outside of that short dated flow. So when we build our options charts, our gamma exposure levels, we're looking across the entire chain. And we also look at the current day expirations as well for our flow and for our gamma exposure models, as well as for the SPX options visualizer. Here's one of the full chain charts of net options exposure. You can see right now we're building this really important level of exposure around 60-50, 60-55, and 60-60, right? This is an area where we could get a little bit stuck, but the further we're able to break away from 60-50 to 60-60, the more I think we have potential to get up to these next layers of really large call positioning. So I'm drawing your attention to 6100, 60-50, really this whole area all the way up to 6200 are the areas that I'm looking at, because if we go to the gross exposure, we can also see the market participants are really looking at these levels all the way up to 6200, which is our current wall of calls. So I think we have room to continue higher from here, and probably about 143 points on the S&P before we start to see more formidable resistance. That's not to say 6100 and 6150 won't be a bit magnetic. They may be a little bit of levels where we get a bit stuck, where we see some resistance, but 6200 is really the bigger level I'm watching, unless and until we see positioning roll meaningfully higher. For now, though, we have seen more market participants roll positioning back higher again. There's less interest in hedging. Skew has fallen. There's more interest in long side exposure, a bit of a FOMO element, but nothing that's euphoric of yet after this last sort of reset of positioning from volatility. We're also back in positive gamma territory. This is good. Usually, and kind of close to neutral, right? We're only about 15 points in positive gamma, but it's enough that it matters. It's enough that it's worth watching. So I do think that this positive gamma flip level of 60.42, we're going to want to watch that level. The S&P typically likes to interact with these gamma flip levels. We saw that a lot yesterday in the trade, by the way. If you were on the Traderade Discord, we could see how much there was this sort of ceiling at the gamma flip level before we ultimately started to make a push above it and continued that push into today's tape. So that's another thing to be aware of. We also flirted with it again today. These gamma flip levels, you see a lot of, I would say, resting liquidity there, as market makers are also looking at how they may change their hedging dynamics as we flip into positive gamma, which means you're going to see more selling of rips, more buying of dips, more compression of volatility, and more likelihood of upside continuation on a swing basis. Now let's zoom out a little bit to the big picture. I've got some interesting stuff to share here before we get into the opportunities. One is the surge in net long treasury positioning. I've seen a lot of charts out there talking about TLT and how it's record net short interest, and I'm using air quotes that you can't see right now, and that means that we're at a bottom for it. It can only go higher. I'd like to draw your attention to a couple of mathematical facts before we unpack this chart and what it means. One, TLT is a $50 billion ETF. Two, the Treasury market is a $28 trillion market. Three, the average Treasury auction on the 30-year is in excess of the short interest that you see on TLT. 16% of 50 billion is 8 billion. The average 30-year auction is in excess of that, usually significantly so. So $8 billion of short interest on an ETF that covers the 20 and 30-year Treasury is not a big deal. Okay, 16%, $8 billion of potential demand for TLT if shorts have to cover. But then you have to add some nuance. Are they short? Or is this a hedge? And I would say it's more likely either a hedge or part of a basis point trade, but I don't think that this is the sort of trade that indicates the short interest dynamics in TLT, that a squeeze is coming. There are other squeeze candidates out there. And we'll get into some charts about why I think that is the case. But this chart on screen tells you the opposite, that actually Treasury positioning is the most long it's been in over 2 decades. Let me say that again. We got to go all the way back to 2011 to see this kind of survey result from JP Morgan. And JP Morgan is a prime broker. They deal with a lot of sophisticated, large money managers. And this is a pretty broad aggregate of positioning as a result. So it's far broader than what you see with TLT, right? Why does that matter? Because I would say that actually the dynamics are the opposite, that what you're seeing with TLT could just be a hedge. 16% certainly doesn't really ring the register as being alarming short interest, and ETF short interest doesn't behave the same as short interest in other products. That has a lot to do with the way ETFs can sort of just synthesize new shares into existence. There's no real squeeze dynamic to be played. And the underlying market, again, a $28 trillion market, is so much bigger, even on the longer end of exposure, than the TLT ETF. So with this exposure, and I've looked at some of the other charts for the longer end exposure dynamics as well. They're also very long, the long end. I would suggest that actually we're probably closer to a base in rates on the long end. Like we're probably closer to the lows on the 10s, 20s, and 30s than we are, the highs. The highs were about 4.8% on the 10s, just as an example. I watch that benchmark pretty closely, so I can kind of throw the numbers around easily. I know we're below 4.5%. Markets love that, by the way. Below 4.5% is very bullish for equities. Risk assets tend to get a better bid, especially if there's that, sort of greater certainty about future economic outcomes coming into the rates complex. That part we might have to put on hold. But this chart tells us that any kind of big upside in the economy and the metrics we get on the economy, any kind of unexpected increase in inflation, anything else that jolts the confidence of the long end, which are basically folks that are looking for a slowing economy and much, much more gradual inflation, anything that spooks that mindset is going to set people wanting to sell their 10s, 20s, and 30s. Why does that matter? Because that will have an effect on TLT, on IEF, on other proxies of Treasury exposure. The other thing is, it's different to be a 30-year Treasury bond owner than a TLT owner. If you own a 30-year Treasury bond, you're guaranteed 100 cents on the dollar from the U.S. government. Full faith and credit, all that. If you buy an ETF, there is no maturity. You can hold TLT for 30 years, God forbid, and there's no maturity on that. So you don't have a guaranteed 100 cents on the dollar. You have whatever the yield was during that time, that if you're underwater, hopefully that helps you make up on that position, some of those losses. So I would go on to say that I still think we could see yields in excess of 5%, possibly 5.5% on the 10-year this year. That suggests with a rising yield curve that 30s could be 6% or so. So that tells us there's a lot of potential upside in rates and downside in products like TLT, just based on some of the underlying dynamics, whether we're looking at positioning, econometric data, for labor, for retail sales, for the economy, for inflation and otherwise. And let's go into the inflation picture. Real quick, PCE is sticky. It's still around 2.8% year over year on core. That's not what you want to see if the preferred level and trajectory of inflation is getting back to 2%. We're still a ways away. That is a little bit concerning because, obviously the Fed has pulled back. I've talked about this for a while going into the rate cuts last year. I said I thought the Fed was doing too much too soon, and they're likely going to have to take an extended break. And here we are, we're seeing that. And that's still not really priced in to rates, right? Because the Fed's taking extended break because they're concerned about inflation and they think labor's resilient. Yet the long end doesn't necessarily see it the same way. So we'll see who's ultimately right. But I think that it's more likely that there's greater sensitivity now to econometrics in labor, in retail sales, in inflation, in GDP data, and otherwise. And that could push up rates and cause some jitters in products like TLT. So that's why I wanted to bring that up. I've seen that chart going around. I just think it's important we get some clarity. Now, here's an area where I think there could be some interesting continuation, and that's gold. I'm still looking for $3,000 an ounce. It's just over $100 from where we are now. But remember, I've been talking about $3,000 an ounce for over 6 months now after we hit our target of $2,700 an ounce in September for September. So I didn't just get the price, I got the timing right on that. I said, you know what? Let's look towards gold getting to 3,000. Even as we were approaching that target, I started to look for 3,000 in the first half of this year. So I think that was over summer. I made those two calls, 2,700 in September, 3,000 the first half of 2025. We are right on target. Now, with that in mind, we're not alone. There's a lot of people that are very excited about gold. That makes me a little nervous in the near term. I think in the near term, it's time to be a little careful in terms of size. So once we get up to that 3,000 level, I'm taking off my core position of my swing long in gold. That's 2/3 of the position. It's been a very, very good trade. And so I wouldn't mind booking some profits, looking for the potential of a pullback or maybe some other areas of opportunity. So that's how I'm navigating that trade. Right? There's always other opportunities for our capital too. As positions get crowded and there's lots of FOMO and it becomes a little more risky, it's good to consider rotating. So I'll be taking the core off and leaving just runners or a third of my position on in gold after we reach that $3,000 mark, which I assume is all but certain at this point. And the imbalance that lies at the heart of global trade. The U.S. consumes more than it produces. China produces much more than it consumes, and Trump wants to change this. This is leading to some nervousness in boardrooms. You can hear it. The tariffs discussions during conference calls is surging back to levels we haven't seen since 2018. So that is one of the elements that changes how companies may decide to invest, how aggressively they might try to expand or build overseas relationships, how you might see reshoring become a factor again, and more than friendshoring, reshoring back to the United States, because it seems like Trump's making it pretty clear he really wants not just products to be made in friendly countries, but products to be made right here in the United States. And we see that with the way that Trump has really imposed an enormous amount of tariffs on Chinese made goods, 525 billion. This is with Trump's addition, right? So that's another 10%. And yet China is only imposing tariffs on about $14 billion of U.S. goods. So it tells you China doesn't have a very strong hand. And if you go back to the first chart, you can see part of that's because they don't import as much, particularly from us. And we import a lot more and a lot from them. They're one of our largest trade partners. So you can see they don't have as much leverage, which means you can expect risks to play out elsewhere, such as U.S. tech, where China's likely to target Google, Apple, Nvidia, and others for what they call anti-competitive practices or otherwise. That is something to at least be mindful of as a risk. It's not an enormous risk, but it is a risk to be mindful of. Switching over to flows, Goldman Sachs prime book flows show last week, going into this week, hedge funds were aggressively shorting U.S. stocks. In fact, you can see that here as well. The net flow was just absolutely bonkers short. And you can see that going into last October as well. That helped to mark a bottom. And the market, I think this time it also helped to mark that near-term bottom. We saw that exhaustive pre-market low on Monday going into this week when people were already shorting in the hedge fund industry. So this also led to broader aggregates of positioning coming down. We could see that stock investors have modestly reduced their net longs. And while it says only modestly in the chart above, typically during a bull market, that's what happens. You have these modest reductions, you shake out the weak hands, the folks playing with too much leverage, and then the bull market continues to climb. Another interesting chart, this one from UBS, showing equity positioning. US lighter, EU longer. Well, what this tells me is it's time to long the US and fade the euro stocks, right? So fading the stock 600 and going long in the US. And I have several opportunities that I think fit that description for the long side. So let's talk about some of the opportunities. Some of these are new and some of them are ones that we've been tracking for a while that are doing well. So we're going to go through first XLE, back on my list as a long, crossing above the 21-day EMA and 50-day SMA. I think this one, guarded by the 50-day to guard risk, that's that blue line, is a long here, targeting some of those prior highs around 94 bucks. I'm not looking for a huge move with that 2/3 of position or core, but I am looking for some upside. So I think those 94 March calls could be an interesting long strategy, or buying the 94 and selling the 96 for a vertical spread, a bullish vertical call spread for March. Either one of those look interesting to me on XLE. Another one I like here is Malaysia EWM. I think this one could actually pop. I think it's put in a classic W double bottom, and I'm looking for this one to actually make a pretty big move. So I'd be looking for this one to get back to about 25.50, 25.60 from here. And so we're not necessarily saying we're getting back to the old highs, but we're going back to a chunkier area on the volume profile, which I think is going to act as a bit of supply. This is an area of the world where I also think longer term, there are some very compelling opportunities. So for longer term investors that are starting to build exposure to emerging markets, maybe out of valuation concerns or just wanting to diversify to other geographies, EWM also fits the bill for me there, nibbling dollar cost averaging along the way. Another area that I have my eye on again is silver. I think it's time to look at some of the other plays in the space. Silver itself, I think, is easily headed back to 35 bucks. Maybe we even get back to some of those higher levels that we've seen in silver in prior years. But for now, I'm looking at SVM to play silver because I love this bottom that the stock is making, and I'm looking for a gap fill, right? I'm not necessarily looking to go all the way back up to 4 bucks, but $3.80 to the bottom of this range, that's where I'm looking for this stock to go. I would guard my risk with the 50-day. That's really what I'm looking for on all of these right now, is guarding risk with the 50-day and taking that risk up to the bottom of this gap around $3.08 to take the entire position off. It's a very simple swing trade. It's looking for a bit of continuation of this positive momentum, these higher lows and higher highs that we're seeing here, that very much suggest we could get back there. I would not build the full position at once. When I'm swing trading, I tend to nibble. So I usually buy a third or a quarter and then come in, with some volatility in the price action, whether up or down, buy another third and a quarter to build that full position. I like to realize I'm not necessarily smart in the market, so I can use the volatility of the market to build a position at a better cost basis overall. Another area that I like a lot right now is RSP. This is the equal weighted S&P 500. This is where I think we have an opportunity to take some long positions that could outperform SPY and outperform European stocks. So this would be the other side of that pair trade. Long RSP, short EZU, or another one of these European ETFs could be a pair trade to consider. But at the very least, long U.S. exceptionalism broadening out to the inglorious 493. That is the basis of the RSP trade. It is longing the other components of the S&P 500, all of them in equal weight, right? We're not just going long Mag 7 for 30, 40% of the S&P. We're going long RSP, where each one of the 500 companies has the same amount of exposure. And so for me, when I'm looking at this earnings picture broadening out, I'm looking at the market and the rally broadening out, I'm looking at RSP to be an outperformer in that environment. I'm also looking at QQQE the same way. This is the equal weighted NASDAQ 100. This is another one where I think some of the other components are due for a major catch up. So you'll notice a theme: equal weight NASDAQ, equal weight S&P 500. Those are two swings that I think could work really well for a longer period, like I'm talking months, maybe even throughout this year. Then there's the hack ETF. This is one I want to buy on dips every time it breaks above the 50 again. So every time this thing dips below the 50 and we get that break above, I want to buy it. That's just a very simple strategy for hack, and I'll guard my risk with the 50, stopping out below and buying as we perk back above it. Over time, that strategy has been a winner. It's made money, and it gets you out of the way of a bigger breakdown should this not cap off so quickly. So if you're to see a broader market sell down and we don't necessarily get back right above the 50, like a beach ball kind of bouncing back above water, that stop below the 50 strategy can get you out of the way of the worst and put you on the right side of the momentum. And you're only losing, a couple of percentage points of performance, but you're guarding a ton of risk just using that simple strategy on hack. And finally, DBA, we've been long this one for a while. I have scaled out of some of the position, but I'm still long, and I'm still looking for this to continue going strong. You've got cocoa, coffee, softs, some of the grains, all really looking positive. Corn continuing to rally. Some of the live cattle futures also making new highs. So for me, agriculture is still part of the inflation story. Trade wars and tensions tend to push these things higher. And I do think weather conditions will also portend to a more uneven harvest. So there's a lot of catalysts for DBA. So that's going to cap it for this episode of Navigating the Markets. Really appreciate everyone tuning in. Hope you found this valuable. You're always welcome to send me questions and feedback, chart requests, and other things. mayhem@traderade.com. That's mayhem@traderade.com, or catch me on the Traderade Discord. And we do this every week, Wednesday at 5 p.m. Eastern. So be sure to tune in. If you can't watch it when it comes out, I will also always share the recordings on our website. Talk to you soon.